Hi, this is Peter Schiff again. It's Thursday, May 21st, 2009. Well, I think we had a very significant day today in the markets, one with potentially a rather significant implications for the U.S. economy and financial markets. What we had today was a synchronous decline in all U.S. financial assets, the stock market, the bond market, and the dollar. What had been happening in the recent past, let's say the last 6-7 months, whenever you got a sell-off in the stock market, the bond market went up. And whenever the bond market or the stock market went up, the bond market went down. Also, when the stock market went up, the dollar went down. And when the stock market went down, the dollar went up. And what was happening is people were either moving to the perception of safety, meaning US dollars and US treasuries. And I say perception because there really was no safety there. And when they were willing to take some risk, they moved back into stocks and they sold bonds and they sold the dollar. And a lot of people jumped to the wrong conclusion recently when they're talking about green shoots or mustard seeds. When they saw the stock market moving up and the bonds moved down, they thought it was because the economy was growing, and that's why people were moving into stocks, and that's why interest rates were backing up a bit. I always argued that it was just simply because more inflation was being created, and I think my view is the correct one. But what happened today is not only did you have a flight from stocks, but a flight from the dollar and from bonds. So instead of there being a flight to quality into the dollar, people seeking quality fled the dollar. And where did they go? They went into gold, which was up $15 an ounce today. Or, of course, they went into the euro. They went into the Japanese yen. And I think what's happening is that perception is changing. And I think going forward, there's a good chance that as stocks decline, the dollar is going to go down too. And so will bonds. And this is really going to be what ushers us into the real economic crisis that I've been predicting, when not only do we have a recession that's going to get worse, but it's accompanied by rising interest rates and rising inflation, meaning higher consumer prices, thanks to weakness of the US dollar. Now, one of the events that sparked it was the talk with S&P looking at debt in Great Britain, where they put them on credit watch. Great Britain has a AAA rated credit. And S&P said they're watching it, and they've adjusted their outlook to negative, meaning that it's no longer stable, that they might downgrade them to something lower than AAA. Also, now you have people thinking that maybe the same thing is going to happen to the United States. Now, of course, there are a lot of people that try to point out that this is all nonsense, that the United States government debt shouldn't be downgraded because there's no way we're going to default. They argue that we have printing presses. We can always pay our debts because the government can print the money. Well, they just don't get it, because that's the problem. You see, when you're rating sovereign debt, when nations are issuing debt in their own currency, default is never the issue. When nations are issuing debt in other currency, that's when default is a concern. For example, if Great Britain were issuing debt in Swiss francs, S&P was rating it, they might downgrade it, because they might think that if if the UK is in trouble, they might not have the francs. But they always have the pounds, they always have sterling, because they have a printing press. They can print sterling. They can't print francs. Only Switzerland can print Swiss francs. The same thing with the United States. So when S&P is rating our debt, which is all denominated in our own currency, it's not a question of default. They know we're not going to default. The question is, are they going to run up the printing presses? Are we going to pay back our debts in real money? The way to pay back your debts in real money is you tax your citizens, and then you pay back your debts. But if you can't tax your citizens, you're not willing to tax your citizens, then you print money. But then when you pay back your debts with printing press money, you're really defaulting, because the money loses value. And so that's what S&P is really rating. It's inflation risk. It's purchasing power risk of U.S. sovereign debt. And of course here, it's not even a matter of conjecture. We know that we're going to inflate our debt away. That's our stated policy. The Fed is out there monetizing debt and smiling about it as if it's a good thing. It's telling us that we're going to buy treasuries. We're going to buy trillions of treasuries. And if that doesn't work, we're going to buy trillions more. We're running these huge deficits, and we're bragging about the fact that we're not raising anybody's taxes, that we're increasing government spending, and we don't care if the world doesn't want to lend us any money, because Ben Bernanke is going to print it. Well, obviously, our debt shouldn't be AAA rated. It's a joke. By the time S&P gets around to downgrading our debt, it'll be too late. The dollar would have already collapsed. It'll be like these Wall Street firms who keep a buy recommendation on a stock until it files bankruptcy, and then they reduce it to a hold. Now, a hold what? There's nothing left. And remember, S&P had AAA ratings on a lot of subprime mortgage pools that became completely worthless. And the U.S. government is every much as big a AAA rated credit risk as any of these subprime mortgages were. But the point of the matter is people are starting to wake up. And people are now not just selling stocks, but they're selling U.S. dollars. And so what I think is going to happen, if we get another round of global stock market decline, if the foreign stock markets that have been on a tear these last few months, if they now turn down in sympathy with the U.S. dollar, what I think is with the U.S. market, what I think is going to be different this time is that rather than the dollar going up, the dollar is going to go down. And so if I'm right, instead of losses on foreign stocks being magnified by strength of the dollar, those losses are going to be cushioned, or lessened by weakness of the dollar. And so that's what I think is a big change. Also, I want to talk a little bit about what's going on with GMAC, where the government is now giving $7 or $8 billion more to GMAC, and it looks like they're probably going to take over the whole company. I mean, why is GMAC bankrupt? They're bankrupt because they made bad loans to people to buy cars they couldn't afford, and the borrowers aren't paying back, and the cars have lost value, and they're broke. Well, instead of allowing the free market to bankrupt this company, which is exactly what we need, we're going to give them more money so they can keep doing exactly what led to their bankruptcy in the first place. Instead of allowing the free market to punish people for doing wrong, here you have the government rewarding them. And of course, what's going to happen now? General Motors and Chrysler, which are now basically bankrupt, they're going to be able to get their customers to get sweetheart deals from the government, who's going to absorb the losses. What the government is now going to be in the business of doing is helping people buy cars they can't afford with money they don't have. Buying cars now, no one needs any money. You just walk into a showroom with no money, and you walk out with a brand new car and a sweetheart deal from the government. And of course, Ford, that didn't take any bailout money, that's still trying to go it alone, now they're going to be at a competitive disadvantage because their customers aren't going to be able to go to GMAC. They're going to have to get credit from Ford, which is going to have to worry about losses, and so they're going to have to price credit more appropriately. The government doesn't care about losses. And this is exactly what we did in the housing market, right? We were encouraging people to buy homes that they couldn't afford, and now we're bailing out the lenders who loaned them the money, and now we're doing the exact same thing with the auto industry. And who knows, maybe one day the government's going to allow, Ford to come in. But what about foreign cars? Is the government going to subsidize cheap loans so Americans can buy imported cars? And if we don't, isn't that a de facto tariff? Isn't that a form of protectionism? Of course it is. This whole thing is nonsense. Of course, everybody forgets about the fact that none of this is constitutional, but that doesn't even come up in the debate. No one even cares whether or not it's constitutional or not. We're talking about another unconstitutional government plan. I mentioned, I gave kudos to my client, Alan Grayson, who's in Congress now because of the way he was grilling the Fed guys and the guys from Wall Street. But unfortunately, he's sponsoring a very typical liberal bill, an elitist type bill, mandating vacations, paid vacations. And of course, the unintended consequences here is, they say, well, companies that have fewer than 50 or 100 employees are exempted. So number one, companies have an incentive not to hire additional people or to fire a few people so they don't come into the requirement. But of course, the law isn't going to really mandate free vacations. What's going to happen is employers are going to have to cut back on what they pay people so they can afford to give them that vacation. And so what this law really mandates is that employees take more of their compensation in leisure and less of it in wages. And it's a very elitist attitude because if the employee wanted the leisure instead of the wages, he would negotiate for it. Obviously, they prefer the money, but you simply can't legislate higher wages. Wages have to come from higher productivity. And that's something government's never going to figure out.